While everyone was analyzing charts and technical indicators last week, silver did something that caught most traders completely off guard. It dropped over 10% in a matter of days, falling to levels just below $75 before managing to claw back some ground. Now here is where this gets interesting. A former executive who used to run the precious metals trading desk at JP Morgan has come forward with an explanation for this crash. And what he is saying directly challenges everything the manipulation crowd has been claiming for years. Robert Gototl spent years at the heart of one of the largest bullion trading operations in the world. And according to him, this sell-off had nothing to do with coordinated price suppression. He says it was structural. He says the banks are not short in the way people think. And he says anyone screaming manipulation is missing how modern risk management actually functions in these markets. Now, before we go any further, if you value analysis that presents multiple perspectives, instead of just telling you what to think, subscribe to Element Axis right now. This channel is built on examining all sides of the data, not cherry-picking information that fits a predetermined narrative. Hit that subscribe button and turn on notifications, because the precious metals market is moving fast, and the next major development could happen any day. You need to be here when we break it down. Let me start by giving you the facts about what actually happened, because the size of this move matters. Silver fell 10.5% in a single week. The low touched just under $75 before bouncing. That kind of volatility destroys leveraged positions, triggers margin calls across the board, and shakes out anyone who bought near the top with too much conviction and not enough capital. Gold was not immune either. It dropped nearly $150 in the same trading session and briefly tested the $4,880 level before recovering. To put this in context, silver has rallied roughly 150% from lows around $28 to highs above $70 during this cycle. Gold has climbed from $2,600 to $5,000 over the past year. These are historic bull market moves, the kind that create generational wealth for early positioned investors and devastating losses for late arrivals who pile in with maximum leverage at exactly the wrong time. So the question that matters is simple. Why did prices drop so violently? Was this manipulation, or was it something else entirely? Robert Gototl has an answer, and whether you agree with him or not, his answer deserves serious consideration because this is not some random commentator. This is someone who sat at the controls of a major bullion trading desk and knows things the rest of us can only infer from outside data. At the same time, and this is critical, he has every reason to defend the industry he came from and the institutions that built his career. Both of those realities can exist at the same time. So we need to examine his claims with respect for his experience and appropriate skepticism given his obvious conflicts of interest. Let me walk you through his core thesis, because understanding his argument is essential even if you ultimately reject it. Gototl is saying this sell-off was caused by structural pressures inside the risk management systems of major institutions. As prices climbed and volatility increased, banks and hedge funds were forced to reduce their exposure. These reductions were not discretionary decisions made by traders sitting around plotting how to suppress prices. They were automatic, triggered by risk limits that activate once certain thresholds are crossed. In other words, this was not a deliberate attack. It was mechanical risk management doing exactly what it is designed to do when markets become unstable. He specifically points to something called VAR limits. VAR stands for value at risk. It is a metric that quantifies how much money an institution could lose on its positions in a worst-case scenario over a defined time period. Every major bank and fund has VAR limits set by their risk departments. When positions approach those limits, traders are forced to cut exposure whether they want to or not, regardless of their market views. Here's the critical insight Gototl provides. VAR limits are typically set in dollar terms, not in contract terms or ounce terms. If your VAR limit is $10 million and the price of silver doubles, you can suddenly hold only half as many contracts before hitting your risk ceiling. The same dollar exposure covers fewer ounces at higher prices. Think about what that means in practice. As silver ran from $28 to $70, every institution operating with VAR-based risk limits saw their capacity to hold positions shrink dramatically. They were not choosing to reduce exposure because they thought silver was going down. The mathematics of their risk system was forcing them to reduce exposure. And when volatility spiked, which it absolutely did with implied volatility approaching 100% before the sell-off, that capacity shrank even further. Gototl describes a situation where banks were retreating and unable to warehouse risk. No one was left to absorb the selling pressure, and once the selling started, it fed on itself. Selling creates more selling in a nervous market where everyone is watching. The same risk gauges flash red at the same time. Drop a comment right now and tell me whether you find this explanation convincing or whether you think this is just sophisticated cover for the same old manipulation playbook. I genuinely want to know how you are processing this because Gototl is making a serious argument backed by real experience, but that does not automatically make him right. Now, let me address the most controversial thing Gotautel said, because this is where the debate gets heated, and where a lot of people in the precious metals community will completely reject his thesis. He said, and I am quoting directly here, that the banks are not short. That statement flies in the face of what many analysts have been arguing for years. The concentrated short positions held by major banks on the COMEX have been central to the manipulation argument. The theory goes that banks maintain massive short positions, that they deploy strategically to cap rallies and suppress prices whenever upward momentum threatens to get out of control. Gotautel's counter is that bullion banking primarily operates as an arbitrage and financing business. The futures positions that appear short on exchange reports are typically offset by over-the-counter exposures and client hedging activity. When you see a bank with a large short position on the COMEX, according to him, that position is hedged somewhere else in the system. The bank is not expressing a directional bet that silver should go down. They are facilitating client transactions and earning a spread for providing that service. He also makes a compliance argument. He says compliance departments are all over the trading, meaning that institutional positioning is constrained by regulatory oversight and internal controls rather than coordinated intent to manipulate prices. This is a serious argument from someone with genuine expertise. Gotautel ran the bullion desk at JP Morgan. He knows how these operations work from the inside in ways that outside observers simply cannot. When he says banks function as market makers and arbitrageurs rather than directional speculators, that comes from direct experience. But here's where we absolutely must apply critical thinking and examine the other side of the ledger. JP Morgan paid $920 million in September 2020 to settle charges of precious metals market manipulation. That case is documented. The settlement included admissions of wrongdoing. Traders from the bank's precious metals desk were prosecuted for spoofing, which involves placing orders with the intent to cancel them before execution in order to manipulate prices and deceive other market participants. This was not ancient history. This happened less than 6 years ago. So when a former JP Morgan bullion desk executive goes on record saying the banks are not short and there is no coordinated manipulation, we have to weigh that statement against documented evidence of the exact behavior he is denying ever happens. The Department of Justice did not fabricate those charges. JP Morgan did not pay nearly $1 billion to make imaginary allegations disappear. The manipulation happened. It was proven. It resulted in criminal prosecutions and one of the largest settlements in the history of commodity market enforcement. Now, it is possible that Gotautel is describing how the business is supposed to work in theory, while acknowledging that some individual traders violated those norms in practice. It is possible that the settlement and prosecutions cleaned up the industry and current operations are more legitimate than past ones. It is possible that structural liquidation and manipulation by certain actors can both be real forces operating simultaneously. This is where nuance becomes essential. The world is rarely as simple as pure manipulation or pure innocent market mechanics. Both forces can be active at the same time in the same market. The real question is which force dominated during this particular sell-off. If you are getting value from this breakdown, hit that like button right now. It helps this content reach more people who need both sides of the story, and it tells me this is the kind of analysis you want to see more of. And if you have not shared this video yet, send it to someone who trades precious metals or holds physical metal. This is information that does not get presented fairly in most places. Let me give you the evidence that actually supports Gotautel's structural liquidation argument, because dismissing him entirely would be a mistake. The timing of this sell-off matters. It happened right ahead of the Lunar New Year period, when liquidity thins dramatically, Asian markets close or operate on reduced schedules, and positioning becomes fragile. In that kind of environment, concentrated exposure can unwind very rapidly. The volatility data supports what he is saying. Implied volatility in silver was approaching 100% before the crash. That is extraordinary. Normal silver volatility runs 30 to 40%. At 100% implied volatility, every single risk management system on the planet is screaming to reduce exposure. Options become incredibly expensive to trade. Delta hedging flows become enormous. The market becomes mechanically unstable, regardless of anyone's directional intentions. The price level matters as well. Gotautel makes the observation that $5,000 gold is a fundamentally different animal than $2,600 gold. The dollar value of moves is larger. The ranges are wider. A 5% move at $5,000 is $250. The same percentage move at $2,600 is only $130. Higher prices mean higher volatility in absolute dollar terms, even if percentage volatility stays constant. He also points to leverage in the system. His quote is direct. Bull markets do not die from corrections. However, excess leverage and blind consensus create these violent corrections. This matches observable reality. The rally attracted leveraged speculators who amplified moves in both directions. When the market turned, that leverage worked in reverse, creating cascading liquidations. All of this is plausible. All of this is consistent with how modern financial markets genuinely function. Gotadal is not making things up. He is describing real mechanics that actually affect prices. But now, let me give you the counter-evidence, the data from physical markets that his explanation does not fully address and cannot easily explain away. Shanghai premiums have been running $10 above Western spot prices for weeks. Under normal market conditions, arbitrage should compress that spread. If prices in Shanghai are higher, metal should flow east until prices equalize. The fact that this premium persists week after week tells you something fundamental is broken in the arbitrage mechanism. Physical demand in Asia is not being satisfied by Western supply at Western prices. COMEX registered silver dropped below 100 million ounces the same week as this sell-off. 4.7 million ounces were withdrawn in a single day. The vaults are being drained while paper prices are crashing. If this were purely structural liquidation with no manipulation component, you would expect physical metal and paper prices to move in the same direction. Instead, we are seeing physical metal leaving the system while paper prices collapse. That divergence demands an explanation that Gotadal does not provide. The Shanghai Futures Exchange suspended 22 account groups in a single week for trading violations. Exchanges do not take enforcement actions like that lightly. 22 suspensions suggest coordinated activity that crossed lines even a permissive exchange would not tolerate. If manipulation does not exist as a meaningful force in these markets, why is the Shanghai Exchange cracking down on it so aggressively? SLV outflows during the crash were minimal. The largest silver ETF saw almost no redemptions despite a 10% price drop. When you see that kind of effort to push prices down, produce almost no result in terms of physical metal being shaken loose, that is not a sign of strength in the manipulation thesis. That is actually a sign of desperation. Holders are not selling, despite double-digit drawdowns. Open interest relative to registered physical inventory remains above 3 to 1. 300 million ounces of paper claims against less than 100 million ounces of deliverable metal. Gotadal talks about VAR limits forcing position reductions, and that is fair. But the aggregate structural position of the market still shows paper claims far exceeding physical backing. That imbalance does not disappear because of 1 week of liquidation. Central bank gold buying continues at record pace. Gotadal himself acknowledges this reality. He cites World Gold Council's survey data showing 75% of central banks expect to continue buying gold over the next 5 years. His quote is revealing. A central bank never makes a decision based on price. They make a decision based on policy. If underlying demand from official sector buyers is this strong and persistent, why are prices falling so violently? Central banks do not panic sell. They do not get margin called. They accumulate based on long-term policy mandates that do not change with weekly volatility. Let me tell you what I think is actually happening here, because I do not believe this is a binary choice between pure manipulation or pure mechanics. I believe both forces are operating simultaneously, and understanding that is critical. Here's my synthesis. The rally attracted massive leverage and speculative positioning. As prices rose, VAR limits compressed capacity at major institutions, exactly as Gotadal describes. Volatility spiked, further constraining risk appetite across the board. The Lunar New Year period created thin liquidity conditions. And into that fragile, unstable environment, selling pressure was applied. Whether that selling came organically through risk management algorithms or was deliberately triggered by actors who understood exactly what the consequences would be, the result was a cascade. Once prices started falling, leverage unwound mechanically. Margin calls triggered forced selling. Risk systems at every major institution screamed to reduce exposure, and no one was positioned to absorb the flow because everyone faced the same constraints at the same time. Did someone deliberately light the match that started this fire? Probably. But was the match all that mattered? No. The fuel was the leverage, the volatility, the compressed risk capacity, and the thin liquidity. The fire spread because conditions were perfect for fire, regardless of exactly how it started. This is why the manipulation debate often misses the larger point. Whether banks actively conspire to suppress prices or simply create market structures where price suppression happens mechanically through predictable system dynamics, the outcome is similar. The question is not really about intent. The question is about structure. And the structure of precious metals markets with concentrated positions, fractional physical backing, VAR-based risk limits, and periodic liquidity windows creates outcomes that look like manipulation whether or not anyone is actively coordinating. Share this video right now with someone who needs to understand both sides of this debate, because this is not information you're going to get from mainstream financial media or from true believers on either extreme of the manipulation argument. Gotadal is right that risk systems do exactly what they are designed to do. He is right that leverage unwinds create violent corrections. He is right that higher prices and higher volatility compress institutional capacity to warehouse risk. All of that is accurate and important to understand. But he is not addressing why physical premiums persist in Asia. He is not addressing why vault drainage continues at the COMEX. He's not addressing why the Shanghai Exchange is suspending accounts for trading violations. And he is not addressing the documented history of manipulation at the exact institution he used to work for. His explanation is incomplete, even if it is partially correct. Now let me give you the technical picture, because price levels matter for managing risk regardless of what caused the move. Silver hit a low just shy of $75 during this sell-off. That level held, and price bounced back above 77. The question now is whether 75 becomes established support, or whether we retest and potentially break through that level on the next wave of selling. For paper traders using leverage, these levels are critical for risk management. You can be absolutely right about long-term direction and still get stopped out by volatility if you do not respect chart structure and manage position size appropriately. For physical accumulators, the calculus is completely different. Pullbacks create buying opportunities. The worse the paper price looks, the better the accumulation price becomes. If you believe the fundamental thesis about physical supply tightness, about de-dollarization, about central bank demand, about the breakdown of paper-physical arbitrage, then volatility is your friend and not your enemy. Here's what GoTotal got right that everyone should internalize, regardless of where they stand on the manipulation question. Bull markets do not die from corrections. They die from leverage unwinds that break the underlying demand structure. And what we saw last week was leverage unwinding. It was violent and scary for anyone overexposed, but it does not necessarily change the fundamental supply and demand picture. Central bank buying continues. Physical demand in Asia remains strong, as evidenced by persistent premiums. COMEX vaults continue to drain. Industrial demand for silver from solar panels, electronics, and other applications has not disappeared. The structural forces that drove prices from 28 to 70 are still operating. A 10% correction in a bull market that has already delivered 150% gains is not unusual. It is not bearish. It is normal market behavior. Here is what you need to watch in the coming days and weeks. Watch whether $75 support in silver holds on any retest. That level marked the low of this correction. Breaking below it suggests more downside ahead. Holding above it keeps the consolidation constructive. Watch Shanghai premiums closely. If physical premiums compress during this correction, that would support the structural liquidation thesis. If premiums persist or expand despite lower paper prices, that confirms the physical paper divergence we have been tracking. Watch COMEX vault levels. Does the drainage continue during the correction or does it pause? Physical withdrawals during price weakness tell you informed holders are accumulating, not panicking. Physical deposits during weakness would suggest sellers appearing. Watch March delivery intentions on the COMEX. How many contracts stand for delivery versus rolling forward or settling in cash? The delivery data reveals how serious physical demand truly is regardless of paper price action. Watch central bank buying data as it gets reported over the coming months. The official sector provides a structural bid that does not panic sell. If central banks continue accumulating, the foundation of the bull market remains intact. Watch gold relative to its recent highs. Gold tends to lead silver. If gold stabilizes and pushes higher, silver typically follows with leverage. If gold breaks down further, silver will likely underperform. Watch volatility levels. GoTotal specifically identified high implied volatility as a factor compressing risk capacity. If volatility subsides, institutions can rebuild positions. If volatility remains elevated, continued instability is likely. Comment below and tell me what you think about GoTotal's explanation. Do you find it convincing? Do you think he's right about structural dynamics but wrong about manipulation being absent? Do you think he is providing sophisticated cover for an industry with documented violations? This community has sharp analytical minds, and I want to hear your perspective on this. Let me give you a framework for thinking about this entire debate, because I think most people get trapped in false binaries. There are three possibilities. 1, markets are purely mechanical, and manipulation claims are always wrong. 2, markets are purely manipulated, and mechanical explanations are always wrong. 3, markets operate through mechanical systems that can be exploited by actors who understand those systems, creating outcomes that look like manipulation, whether or not formal coordination exists. I believe possibility 3 is closest to reality. The structure of precious metals markets creates predictable vulnerabilities, thin liquidity windows, VAR-based position limits, fractional physical backing of paper claims, leverage that amplifies moves in both directions. Anyone who deeply understands these mechanics can exploit them without needing to coordinate in ways that would trigger obvious regulatory action. GoTotal describes the mechanics accurately. But describing mechanics is not the same as proving those mechanics were not deliberately exploited by sophisticated actors who knew exactly what the consequences would be. JP Morgan did not pay $920 million because their traders innocently made markets and got unlucky. They paid because specific patterns of behavior were identified that constituted manipulation under the law. So the structural liquidation Gotadal describes was absolutely real. The question that remains unanswered is whether it was triggered deliberately by parties who understood the system well enough to know what would happen once the first domino fell. That question may never be answered definitively with the kind of proof that would satisfy everyone. What we can do is track the data, understand the mechanics on both sides, and position appropriately based on our assessment of risk and reward. If you found value in this examination of both perspectives, if looking at the evidence from multiple angles helped clarify your thinking about what happened last week, subscribe to Element Axis if you have not already and turn on those notifications. Join the conversation in the comments. Tell me how you are positioned and whether this volatility changes your strategy or reinforces it. The debate about manipulation versus mechanical liquidation will continue as long as these markets exist. What matters is understanding both sides well enough to make informed decisions based on evidence rather than ideology. Stay focused, stay informed. Let the market prove itself through price action and physical flows over time.